Hey everyone, this is Mike Bonn with the Cash Flow Company. Today we're going to go over what is your maximum DSCR loan available per property. Most DSCR loans are based on LTV, 75% for rate and term, 80% purchase, stuff like that. But there's another factor out there that can limit the amount of money you could get out of a property or even make you put more into a property when you purchase it. And that is where the DSCR ratio breaks even. So we're going to go over that today. What we see a lot is people go into like a BRRRR property and they expect to refinance out like a 75 or 80%. And that's typically what happens. But the DSCR ratio is another factor that comes in that could limit the amount you could get out. And you need to know this before you actually purchase a property or look for a refinance. What is your break-even point on your DSCR ratio? So we're going to walk through the numbers today on an example just to show you how it affects you when you're trying to refinance or purchase a property. Let's use an example. Let's say the value of a property is $200,000 just to keep everything simple. And we're going to look at a refi, and typically a 75% rate in term or even a cash out is something that's available. So on a property like this, typically we qualify for $150,000. Our credit score is good. We got the good rates and everything at the 75%. But now let's look at why the property may not qualify. And we're going to use certain figures. At 75%, we're going to use a 7.5% rate. And that's going to come up with $1,050 for a payment. So that's your monthly principal and interest on a $150,000 loan. So if we have the same property, maybe in different areas, different zip codes, or even different states, this property may or may not qualify for that 75% loan. And we're going to go over some of the factors on why it would or would not qualify. Now let's look at why two properties, one may qualify, one may not. We're going to look at the other factors when you're looking at DSCR. We're just going to abbreviate everything. So taxes in a property. You also have property insurance on that property. Some properties and some don't have flood and HOA. So you're going to have to take all of these into account when you're looking to see if it qualifies. Remember, qualification means the rents that we're going to get are going to equal or be greater than our expenses that we're going to come through. Remember, this is our PI. We're going to have to add our taxes, insurance, flood, and HOA. So let's go through. Let's say one property on one side of town, property A, has taxes, or even in a different state, of $1,800. While on the other side, or in other states like Texas, Florida, some of those have higher property taxes. The same property may have taxes of $3,600. And insurance also, like let's say here we have insurance at $1,200. Over here, maybe we're in a state that's a high-risk state, like Florida, with all the issues that are happening over there with hurricanes and stuff. We see insurance at a higher rate. So even though we have the same property, same PI payment, we're going to have different amounts here in the taxes and insurance. And I listed flood and HOA just because you're going to have to come into that, but we're trying to keep everything simple here. So we're going to actually, in this property, neither of them have flood or HOA. We're just going to go off of taxes and insurance. In this case, the total is $3,000, $1,800 plus $1,200, $3,000. We're going to divide that $3,000 by 12 to get the monthly of $250. So now we know what we need to add to this number to see where our break-even point is. So on property, it's $250 plus the payment you're going to make. So this property breaks even at $1,300. The $250, which is your taxes, insurance monthly, plus your mortgage payment, rents have to be at least $1,300 to break even. The same valuation over here, we have $7,200, which is $600 per month. So we're going to divide $7,200 because that's annual, divided by 12, where you get $600 a month. We're going to add the principal and interest. This property here must have rents of $1,650 if you want a $150,000 loan. So even though that you qualify in the DSCR ratio loan will go up to 75 or 80%, in this case, if your rents are not at least $1,650, it doesn't qualify. So an example, say both properties rent for $1,400. And they're looking to get $150,000 cash out. What's going to happen is this property right here will qualify for the whole $150,000 at 75%. This property, since it's greater, the expenses are greater than the rents, is not going to qualify for $150,000 unless you go into a negative DSCR loan. Those are limited also by LTVs, typically 65%. In this case, instead of 150, you may get 120 or 125. So even though you qualify, your credit score is there, and the guidelines say you could get up to 75%, you have to make sure when you're getting into a property or looking at a refinance that that property qualifies for the maximum loan amount too. And that is all based on where your DSCR ratio, your expenses, and your rents equal. Each property is going to be different. Each location is going to be different because there's different numbers here. So before you purchase or before you get into BRRRR especially, make sure you are qualifying your property, finding out where the rents are. We've done videos before, checking out on Zillow where the rents are for that particular area. Find out what they are. Get the taxes and insurance, get the quotes, so you make sure that this property is going to hit the LTV you want, especially on BRRRR, to refinance it out. You may anticipate it's going to finance out at 75% because that's what they qualified you for. But remember, it's not only you, it's the property that has to qualify too. If you have any questions or want to run through an example, just reach out to us. Go to thecashflowcompany.com or hit me up at mike@thecashflowcompany.com.